Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Central banks in Europe and Canada cut interest rates for the first time since the pandemic, lowering borrowing costs and kicking off the easing cycle. Are the Bank of England and the Federal Reserve about to join them?
I want to know how far and fast rates are likely to fall. And in today's dumb question of the week, does it matter if inflation stays above 2%? All right, let's get into it. So, whisper it gently, but the soft landing narrative seems to be on track still. So we're recording this just after the ECB announced a rate cut, a 25 basis points cut, taking their policy rate to 3.75%. And this comes a day after the Bank of Canada became the first G7 nation to cut interest rates. So it's happening, Roman. We've talked about it for a long time. It's finally happening.
And what's interesting is that it's not just a soft landing for the US, it's also true for the rest of the developed world. There hasn't really been a big pickup in unemployment or a huge fall in GDP. Okay, GDP hasn't been amazing, but it's been kind of like a bumpy landing. And you could argue that there's been no landing at all.
What? Pick one. It's either soft, bumpy, or no landing. That's the most hedging thing I've ever heard.
Well, it certainly wasn't a crash. And that's what people were worried about, that there'd be a terrible increase in unemployment, that GDP would tank, and then, there'd have to be emergency measures from the central banks.
Yeah, the pilot just sounded a bit worried, but we've made it onto the tarmac.
Yeah. Who knew? Things actually have turned out to be okay.
Do you think it's unfair that the Bank of Canada and the ECB are getting all the credit? Over in Switzerland, the Swiss National Bank cut its interest rate months ago. They didn't get much of the credit. They didn't make a big song and dance about it.
Yeah, it's like they just don't care. Everyone else is worried about cutting before the US, but for Switzerland, no, not a problem.
Do you think the SNB, the Swiss National Bank, always just sort of do their own thing, don't they? They really surprised markets with their cut. Whereas the ECB today, it was so well telegraphed. Everyone knew they were going to cut.
Yeah, they are out there. They also do weird things like buying equity with their reserves. They're certainly single-minded and they don't really care what other people think. I get that feeling.
Didn't they once just sort of cut their peg to the euro without any warning overnight?
Yes, they did. And I could tell you some stories about that.
Was it a fun day at the bank?
No.
No, it wasn't, no. I mean, if you look at the reasons, apparently, why Switzerland really went first here, is that their currency has been strengthening a lot over the past year, which is good in terms of fighting inflation. It lowers the value of imported goods, but it's not great for Swiss exporters, is it? And I think the central bank just thought the time was right to ease policy, and inflation's come right down there. So it's below 2% and has been below 2% for almost a year now.
Yeah, I spent a lot of time in Switzerland. I love the country. And I think people don't really understand quite how it's such a big exporter. It exports a lot of machinery, a lot of gold, and also pharmaceutical products, a lot of watches, but not much chocolate, as it turns out. But if you are going to be exporting a lot, then obviously you don't want your currency to be too strong. So cutting first, in this case, was actually quite helpful, I think, for Switzerland.
Because people were always saying, can any of the other major central banks go ahead of the Fed? Can they cut before the Fed? And in the press conference, the chairman of the Swiss National Bank, Thomas Jordan, he sort of answered it directly and said, for us, it's not a question of whether we're the first or the last. We make the decision at the moment when we're convinced that it's a good time to make that decision.
They don't care, do they? Some central banks say the same thing, but you get the feeling their heart's not in it and that they're actually pretending.
What, as in they're just waiting for Jerome Powell to do his thing first?
Yeah. Because normally what happens is that the US cuts first, and then it's the UK, the Bank of England, and then it's the ECB. But what was pretty surprising this time around was that the ECB went first.
It'll maybe be in exactly the opposite order. I wouldn't be surprised if the Bank of England comes before the Fed as well.
Yeah, I think they could do. And I think given the weakness of the UK economy, I think that wouldn't be a bad idea.
Do you think elections are going to complicate it? Like if you're a central bank, it looks a bit strange if you sort of cut interest rates a week before an election, right?
I think it's going to certainly weigh in their thinking. They may not admit it again because you don't want to say that politics factors into your decision. You have to say, oh, no, it's all about the economy, but I think the reality is that's not true. I think if there is volatility during a period of political transition, then you don't want to add fuel to that fire as a central bank. Stability is the key word here.
But in a way, they jeopardize their independence by moving just before or just after an election in terms of policy, because even if it's completely unrelated to politics, people will read into it what they want to read into it, right?
And if there is a problem, you can bet that people will point the finger at the central bank and say, oh, look, maybe this was politically motivated to make us look bad. Who knows? But I think they probably want to avoid making big changes just at the same time as there is this transition.
One central bank that seems to pay a lot more attention to the US is the Bank of Canada. And maybe that's because, they're next door neighbours. They're so tightly integrated with the US economy that they have to pay attention to the Fed. But they did go first. So this week they cut their interest rate by 25 basis points down to 4.75%. And this was a move that was largely expected by markets. It wasn't quite fully priced in, but it was odds on.
And just reading through their statement when they actually did the cut, I think it's a kind of mixed picture. They're saying that first quarter GDP was slower than forecast. They had weaker inventory investment and that dampened activity, but consumption growth was solid at about 3%. Business investment and housing activity also increased. So, a kind of mixed picture of something which is slightly slowing down perhaps, which is not that different from what we see in the United States.
Both economies appear to be slowing down a bit, though the US from a stronger position, I think, which is why the Fed is waiting.
And of course, the other problem is that Canada has a huge housing bubble. I mean, in some places, it's just unbelievably bad. So if that's the case, then I suppose one of the worries is that they're going to have that bubble pop in an unpleasant way. But the key point, obviously, is that inflation's easing. And that's the thing that they stress in their statement.
It's still above 2%, though. It's around 2.7%, I think, at the last reading. So even if you look at core inflation, which strips out food and energy and is sort of more predictive of what's going to happen in the future, that's around 2.75% as well. So, they're not down to 2%.
But to quote what they say, with continued evidence that underlying inflation is easing, Governing Council agreed that monetary policy no longer needs to be as restrictive, and they say that recent data has increased their confidence that inflation will continue to move towards the 2% target. So what they're seeing is pretty much a gradual drift towards their target, and so they can ease off the tiller.
I guess that's the point, isn't it? We're talking about cuts, but policy was very restrictive. So it's like the foot's still on the brake. It's just easing off a bit. We're still in restrictive territory.
Yeah, my favourite metaphor is getting a boat onto a dock. You kind of ease off on the paddling just before you get there. And so you just kiss the dock. So I think that's what they're trying to do.
I mean, whichever metaphor you want to use, it could be cars, could be boats. Well, we're talking about planes, aren't we? Soft landing. And the governor of the Bank of Canada, Tiff Macklem, said, so far it looks like a soft landing. But he does caution the plane hasn't been landed yet. We're not cheering yet. The runway's in sight, but we still need to land this. In terms of further cuts, markets aren't expecting them to go much further this year. They're pricing in around another cut or two before the end of the year.
Yeah, I think they'll all be feeling their way. And just as we had synchronized hiking, I think we're going to see synchronized cutting, and it'll be synchronized cautious cutting.
Synchronized hiking sounds like the worst Olympic event ever. I wouldn't be surprised if we get more cuts than the market's pricing in, especially when you look at the Canadian economy. First quarter GDP was below expectations at just 1.7% expansion. Unemployment is already above 6% and wages are cooling. Retail sales have been falling for the last 3 months, every month. And I think quite significantly, households in Canada seem to be more highly leveraged than their counterparts in the US. The household debt service ratio is around 15% in Canada, and it's less than 10% in the US.
That's probably got something to do with the housing market. And I think, house prices, which have just gone really off the map, I think that's been a big problem for Canadians.
If there's a tension between a weak economy and inflation that's still a bit above target, the conditions are there in Canada for them to err on the side of, well, we best cut to support the economy. Whereas in the US, it's more finely balanced, I think.
Yeah, their economy still looks pretty strong. Although, as I'm sure we'll mention in a moment, there are some signs of weakness starting to show.
And what do you think about Europe? Is that more like Canada with a slightly weak economy, or is it the US, which is still doing pretty well?
Well, I think GDP growth has been very, very weak in Europe as a whole. And I think that's obviously going to factor in their decision. So that's going to make them more likely to be willing to cut interest rates to try and bolster a bit of growth.
And they had signaled that they were going to cut at this June meeting a long way out. I remember it being hinted at in ECB press conferences for months now, as they were seeing inflation gradually fall month on month. But then interestingly, last month it ticked up inflation. It rose to 2.6% from 2.4% in April, which in other circumstances might have made them pause again. But, they said so much that they were likely to cut here, and markets had priced it in that I think realistically they couldn't change course.
But it was interesting, given what's happened with Germany, the fact they've had a recession, they've had a huge problem with energy supply and the cost of energy increasing as a result of their disastrous decision to cut nuclear energy at the worst possible time. The one voice that went against the herd was Robert Holzmann. He's actually head of the Austrian Central Bank. But he's also one of the most hawkish members of the Governing Council, the one that wants to keep rates high. He said, data-based decisions should be data-based decisions. So he's not convinced that there's clear signs of disinflation.
Austria is full of hawks on monetary policy, though, isn't it? That's where it all came from.
Isn't their emblem a hawk?
I think it's an eagle, and less said about that, the better. I mean, there's definitely a division in Europe, isn't there? There's always a division between all these different countries, the 20 countries that make up the Eurozone. You could probably characterize it as weaker economies who favor lower interest rates, generally in the south of Europe, and then stronger economies historically who favor higher interest rates like Austria. And that split hasn't gone away. It's not an easy job, is it, for the ECB to set one policy rate for all these different countries? So even now, the inflation rate is vastly different among different Eurozone countries. So it's really low in places like Finland, 0.5% CPI, and Italy, 0.8%. But then if you go to the top of the table, you're looking at Belgium with 4.9% inflation. Those kind of things would imply you need different interest rates.
And as we know, Christine Lagarde's not a big fan of closing spreads. She's famous for her disastrous comment, which is that the ECB is not here to close spreads. In other words, if the periphery's yields are higher than everyone else's, they shouldn't have to worry about making that tighter.
Which is true, technically, but maybe don't say that. It's just a red rag to the bull of the bond markets, isn't it?
Yeah, it's like the opposite of the whatever it takes comment from Draghi, which actually turned things around for the better.
Whatever it breaks. I mean, it's not been easy for the ECB to maintain this high restrictive rate for a couple of years now because economic growth has just not been there. It's been a stagnant economy across Europe for much of that time. Interestingly, now it does seem to have some signs of turning around. So in the first quarter, GDP rose 0.3% versus the prior quarter, which isn't huge, but it's something. And now they've started to cut interest rates. Maybe growth will accelerate from here. That's the hope.
But the worrying thing is about wage growth, which is still very high, the rate of wage growth in the Eurozone. It's fallen back to a pace of 4.75% in the first quarter. And unemployment has also fallen to a new low of 6.4%. That was in April. So we're still looking at a tight labour market and wage growth probably pushing up inflation. So that's kind of the counterbalancing thing, which they have to always be wary of.
Yeah, it's a tough balance, isn't it? I saw some people describing today's move from the ECB as a hawkish cut. Do you like these things where they always put a little adjective on the policy move?
No, that really winds me up. It's just trying to put your prior beliefs onto what actually happened. I just don't think that's true.
What is a hawkish cut, if you had to describe it for me?
Well, you kind of hint that you wanted to keep rates high, or there are lots of reasons to keep rates high, but it was just like a marginal decision to cut, probably.
What I saw people saying was that they expected the ECB to cut and say more cuts were coming, whereas they just cut and said, we'll wait and see. And it was interesting that Bond yields in Germany, for example, did increase a bit after the rate cut, which isn't necessarily what you'd expect. So maybe hawkish cut has something to it.
But maybe this is good for German growth. That may be why the yields in Germany increased. The primary benefit of the euro for Germany has been that it's kept its currency artificially low. If it had its own Deutschmark, I think it would be a much stronger currency than it is today. And Germany really needs those exports. From their point of view, I think this couldn't come soon enough. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Not ready to invest? Trading 212 has recently launched an attractive flexible cash ISA with interest paid daily. Customers can also benefit from the Trading 212 card, which offers 1.5% cash back on all transactions until October the 1st, 2024. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 account and make a minimum deposit of £1 and use the promo code RAMIN, RAMIN, or the link in the show notes. When investing, your capital is at risk. Past performance doesn't guarantee future results. Other fees may apply. Interest applies on the uninvested cash in your account. Free shares can be fractional. Terms apply.
So we've seen interest rates coming down in Switzerland, Canada, the Eurozone, as we've said, also Sweden, Brazil, Mexico, Chile have all cut this year. Is this just a wave that's, going to wash around the world now?
Yeah, I think so. And I think it's to do with the synchronized increases that we saw and a lot of the supply chain issues which are common across most of the world, and the energy shock, which is also shared across much of the world. So as those things ease, I'd expect to see policy follow suit, because it was global factors driving the inflation, and now it's global factors driving the disinflation.
Inflation was pretty tightly correlated, wasn't it, across the world?
Yeah, it's very unusual to see that.
There were a few exceptions, like China's had deflation, for example, but other than that.
To a certain extent, you do see correlation in inflation across developed markets, but this was really unprecedented.
But there are exceptions to the rate cutting cycle here. So the Bank of Japan just ended its negative interest rates for the first time in almost a decade. We don't often talk about the Bank of Japan hiking rates, but also banks in Taiwan and Turkey have surprised markets by raising their rates. Inflation's a bit higher and stickier than you might imagine there. They'd probably be underselling it to say inflation is high and sticky in Turkey.
How conventional of them to actually raise rates in response to high inflation rather than cutting it.
But do you think these countries are kind of the exception to the rule?
Oh, definitely. I think, they're just the outliers. So I think it has been the case that we've had these common drivers, but then gradually what we'll probably start to see is a kind of decorrelation of the business cycles, but also the inflation that we see across the world.
And presumably, like the governor of the Bank of Canada said, there could be more surprises when it comes to inflation. Like, we're not fully out of the woods yet, especially as we talked about last week. Tariffs are coming in. That could be inflationary. There's still unrest in the Middle East. And who knows what's going to happen with energy. So I guess it would be surprising if any of this stuff had to be reversed, and a big shock to markets if we had rate hikes in the next year.
Yeah, I don't think it would be taken well. For example, if we did have an energy spike and then we got an inflation spike and then it started to replay the scenario that we saw previously, that would be really bad for things like growth stocks.
But that's not the central case. The central case is we're going to get a few more rate cuts from major central banks. Presumably, the Bank of England will join in the party, I guess, after the election, who knows? And the Federal Reserve might be the last central bank to move, but it will probably move this year, I think.
Oh, I think so, towards the end of this year, unless there is a surprise with inflation. And I think there are signs that growth in the US is starting to weaken a bit, and some of the macro data in the United States is starting to show some cracks. And if you look at the unemployment rate, it is starting to tick upwards now, and that is a fairly good indicator for the US that things are getting worse.
The manufacturing PMI also looks pretty weak.
Yeah, so not all indicators are pointing to weakening growth, but certainly some of them are starting to show weakness. And that is going to push the Fed towards its first cut.
So long as inflation behaves itself.
Yeah.
Now, how far do you think rates will fall, and over what period of time?
Well, as I say, I think it's going to be a cautious cut. I think they're going to be very cautious because reversing a decision looks really bad.
So you're saying people can't say hawkish cut, but you can say cautious cut.
Sounds the same
with these adjectives.
It sounds the same, but it doesn't have the kind of oxymoron built into it.
Okay, so what's this cautious cut entail?
Well, they always say that they're data dependent, right? So they say, well, this is what we've decided to do, but if anything happens, every meeting is a hot meeting. We still consider what data's coming in, and we could well reverse it. So they have to say that, and I think they mean it. And there are signs that inflation is ticking up and that certain components of inflation are just refusing to go down. In the US, for example, the shelter component, they've been saying for ages that things like rents would fall. But when you actually look at the evidence for it, it's taking a very long time to happen.
And when you say rents will fall, you mean the rate of increase of rents will fall?
Yeah. So disinflation is what I'm talking about.
Just before everyone starts sending in their emails.
So if that happens, they've just got to keep an eye on things ticking back up. And wage growth in particular. In the US, there's no sign at the moment that you've got a wage price spiral. But in the UK, I think you could argue that certainly wage growth remains elevated, and that's going to become a problem.
We've seen so many ways that people have tried to characterize the medium-term outlook for central banks and their policy. Higher for longer was the thing, Goldilocks scenario, all these ways of talking about it. I guess underlying them all is we don't know what the neutral rate of interest is, do we? We've had a decade plus, more than a decade, where rates were zero at the lower bound across much of the world. Now they're higher than that in restrictive territory. They're starting to fall. And presumably the question of how far they will fall is they'll settle back at the neutral rate, barring any accidents. But what is it? Is it higher than the zero it was before? Most people think yes, but is it 3% interest rate? Is it 2%? Is it different in the EU and the US? No one really knows, I guess.
And I think the fact that there is protectionism now and it's become the standard doctrine for most of the developed world, then that's probably going to keep inflation at a higher rate. And that means probably there's going to be a higher neutral rate, would be my guess. The other factors are pushing things in the opposite way. So, for example, demographics, we have an aging population. That tends to be disinflationary because as you get older, you buy less stuff, and that doesn't push up prices so aggressively.
I think the other point here, which I've seen made, is that government debt levels are higher than they were pre-pandemic in much of the world. Deficits are chunky in the US, and it's going to be really hard for governments to cut spending. We've already seen that interest rates on government debt has increased significantly. Like the interest rate bill that governments are having to foot every year on the outstanding debt is significant now. Everything else being equal, that should be inflationary, I guess, or at least should push up the yield on government debt.
Yeah, I mean, the supply of debt has been a big issue. If there's a tsunami of treasuries, then that's going to push up yields. Yeah, so that would push up the entire yield curve from the short end all the way to the long end.
And on the flip side of that, you hear people worrying about financial repression, where there may be political pressure from government on central banks to keep rates artificially low so their interest bill is not so high and maybe inflation runs a bit hot and the debt gets inflated away. This is the fear people have, right?
Yeah, I don't buy that one. I don't think that central banks would consider that because, it's just not their job to do that. That's very much to do with government policy about issuance, and the central bank isn't going to adjust their behaviour to try and keep the debt costs down. Unless it became a systemic problem, of course, and then they could consider it, I suppose. But we're a long way off that right now.
I've just got to put it out there because I see it mentioned all the time on Twitter, people talking about financial repression. All right, so I think we've covered pretty much the whole world there. Now, a provocative question to finish with, Romin. All central banks have got it tough, maybe some tougher than others. Who would you rather be at this moment? Andrew Bailey, Christine Lagarde or Jerome Powell?
So this depends, right, on what you're actually talking about. Is this like being John Malkovich, where you see the world through their eyes and you're kind of trapped in their body? In which case, I'd be Jerome Powell. But if it's actually me in control of the body, I'd be Andrew Bailey, because then I can actually help my country.
Oh, okay. But who's got the most difficult job and who's got the easiest job?
I think probably Lagarde, because it's such a disparate economic grab bag of countries that she has to look after, that it's really hard to formulate policy when you've got a country like Germany and you've got countries like Eastern Europe, all in the same Eurozone. Understanding how economics affects the market is really a complex business, and it's something we often discuss in PensionCraft. And if you want to join our community and learn more about that, just go to our website, PensionCraft.com.
Okay, today's dumb question of the week is, does it matter if inflation stays above 2%? So this whole business of moving interest rates up and then down again, these hiking cycles and easing cycles, as they're called, is all underpinned by the fact that central banks are targeting 2%. But as I understand it, this isn't some kind of iron law that 2% is a magic number. Does it matter if inflation doesn't quite get back there?
I don't think so. I think having some kind of target is helpful, but we didn't always have one. You know, it's a fairly recent thing, even for the Fed. I think it was 2012 when they introduced the 2% target. But having some kind of target's useful, because if you are planning, so let's say as a business, to some kind of 10-year plan, 5-year plan, if you know roughly where inflation's going to be, that helps you plan. Whereas if it's just, we're trying to keep inflation low, well, what does that mean?
At least you got a number to stick in your spreadsheet, right? And the way it came about was kind of interesting, this 2% target. Like you say, it is arbitrary. It could be 1% or 3% or whatever. And I think it was just on TV in New Zealand. Like, central bank in New Zealand was the first one to do this 2% target. And they were just interviewing the governor and said, you know, inflation's 10%, as it was at the time in the 80s. Are you happy with that? He said, no, inflation should be 2%, like an off-the-cuff remark, which then became policy for the whole world.
New Zealand, who knew?
Yeah, at least that's the legend, but, you know, print the legend. I mean, coming out of this inflation spike, and now we're most of the way back to 2%, some people have said the hardest part is that last mile, right? Is to go from 4% or 3% down to 2%. Coming from 12 down to 3 was fine. And you've even seen people like Mohammed Al-Arian saying, well, forget 2%, it's arbitrary. Just keep it at 3%. Be happy with where we are and don't crush the economy to get it down that last percentage point. What do you think about that?
I kind of agree with the argument that we shouldn't try and crush the economy for the sake of 1 percentage point fall. But I think the bank wouldn't do that anyway. They've got certain leeway when it comes to implementing policy. And they always say that they're going to take their foot off the accelerator or the gas, depending on where you live, as they get closer to the target. So I think the target itself isn't so important as their reaction function, as they call it, which is how they behave as they approach the target. And many of them, I suspect, will be easing off the gas well before they get to 2.
What I think is that maybe subconsciously they don't really mind 3% inflation. If it's that for the next decade and the economy grows really strongly, they would probably take that. What they can't do is to come out now and say we're targeting 3% inflation, because markets would not react well to that. You know, it's got to be an unsaid thing.
That's right. And when you change a target, that would be a huge shock. I mean, how would you signal that? You'd have to say, well, that 2% target, do we really need that?
Well, you just do what the guy in New Zealand did, the governor. You go on TV and you say, did we say 2? No, 3. We meant 3.
Or maybe they could just pretend to misspeak during one of the press conferences towards our 3% target and then just see if anyone notices.
I mean, monetary policy is never that precise, though, anyway, is it? You're just trying to get it to go down or up, right? Is policy restrictive or is it accommodative? At the moment, we're restrictive, which in theory is bearing down on inflation. But the other side of this is, what do markets expect inflation to be over the medium term? Do they think that central banks are going to get it under control and it's going to stay at 2%?
Well, there is a kind of market expected inflation, and this is from something called a break-even rate. So let's say you're buying a 10-year government bond. You can either choose to buy an inflation-linked bond or a regular nominal government bond. And there's a certain rate of inflation that's baked into the inflation-linked bond, such that if inflation is greater than that rate over the life of the bond, you're better off buying the inflation-linked bond. So you could say this is the inflation rate which is expected by markets. And usually it's not that far wrong. And if we look at break-evens right now, for 10-year break-evens, for Germany, it's currently 2.04%. So just a shade above the 2% target. And if we look at the US, it's 2.3%. So markets clearly expect inflation to be about 2% over the next decade, which is pretty much job done from the point of view of the Fed.
So I guess to go back to the dumb question, does it matter if inflation is above 2%? It probably does to markets, because markets work on the basis of expectations, and they're expecting 2%, more or less. So if it came in at 4% over the next decade, not so good.
Yeah, I think the primary impact would be on something like the bond market, where 4% inflation would be a real problem. If you've locked in, say, 3% and inflation's 4%, well, suddenly you've got a negative real return. Equity markets can usually absorb anything below 5% without derating, so that would probably be okay.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.